So incorporating your portfolio might not even be the best thing for you to do. You may be paying more tax incorporating your portfolio than if you just left it in your own name. Hi guys, Josh Latharby here and welcome back to my YouTube channel. Today I'm talking about incorporating your property portfolio, giving you some ideas of whether this is the best thing for you, if you need to be in a limited company, or if you're going to be better off leaving your properties as they are in your own name. But before we get stuck in, please do hit that subscribe button below and that bell icon so you get notified as soon as we post more property tax saving content. Otherwise, let's get stuck in. Okay, so since 2015-16, when Osborne introduced the tax changes all around Section 24 and the mortgage interest restrictions, people who have been operating their property portfolios previously in their own name, husband and wife as a partnership, they've all been looking at ways to save this tax because it really does impact higher rate taxpayers quite significantly. The changes, what they effectively do is, rather than in the old ways, mortgage interest was a fully allowable expense. So what this means is if you've got £10,000 worth of profits, £5,000 worth of mortgage interest, that would be an allowable expense, meaning you've got £5,000 worth of profits, you pay tax on that £5,000. However, now it's changed, and what actually happens is that £5,000 mortgage interest, that's not an allowable expense. So your £10,000 that you've got, that's your £10,000 profit at the end of the day. That's what you're going to pay tax on. So if you're a higher rate taxpayer, you'll pay tax at 40% on that. Additional rate 45%, basic rate 20%. And then your mortgage interest, that £5,000, you're going to get a basic rate tax credit on this. So if you're a basic rate taxpayer, you shouldn't be too much affected by this, depending on whether you're at the limit and if you claim any high income child benefit, anything on those lines. But if you're a higher rate taxpayer, rather than getting tax relief at 40%, you now only get tax relief at 20%, which ultimately means you are paying more in tax. To get around this, people started to look at limited companies, because a limited company, as it stands at the moment, still gets 100% of the mortgage interest and finance costs as a tax deductible expense. So going back to that example, a limited company, they pay tax at 19%. If you've got those £5,000 worth of mortgage costs, they come off the profits, meaning you only pay tax at 19% on those £5,000 worth of profits. What we're going to do is we're going to head to the whiteboard and run through a quick example, giving you some numbers to help illustrate. Okay, so here we are at the whiteboard and we're going to run through some examples. So this is somebody, Alice, in her own name. She's got properties in her own name and she's got £60,000 per year rental income. Mortgages of £25,000. So essentially her usual profit before tax in this scenario would be £35,000. PBT, profit before tax, remember what that means. So the tax on this for this current tax year is going to be as follows. We've got a rental income of £60,000. This is assuming no other income, by the way. Less her personal allowance of £12,500 is going to give us income which is subject to tax of £47,500. Yep. So the income tax at this is a mix of 20 and 40% as she's over the higher rate threshold, and there's a total of £11,500 worth of income tax charged on this. However, as you may well know, that we get the basic rate tax credit on the mortgage interest cost. So we've got mortgages of £25,000, and what actually happens is that basic rate tax credit of £5,000, 20% of that £25,000 comes off of the total amount of income tax you've got to pay there. £11,500 less £5,000 is £6,500, which essentially means that the profit after tax is £28,500. That's the cash left in her pocket. So we'll compare that now to a limited company. In a limited company, similar sort of stuff, rental income £60,000, less that mortgage interest £25,000, profit before tax of £35,000. Corporation tax 19%, total £6,650. So the actual profit after tax here is less, £150 less, worse off by being in a limited company. The reason for this is that the majority of the income in that previous example was taxed at 20%. You had your personal allowance available, which was that tax-free element. Limited companies do not have that. So this is a kind of great example to show you that not everyone is better off in a limited company. If you're looking to earn, say, £50,000 worth of rental income, being in your own name, you're going to get cheaper mortgages, a lot easier. It's a lot easier to get mortgages in your own name as well, so that's something worth considering. And from a tax point of view, by the time we've extracted this 28,350 when we've paid PAYE or dividends have been extracted from the limited company, there'd be even less cash available, and the difference between the two would probably be closer to £2,000-3,000 rather than 150. So in this case, Alice is better off keeping those properties in her own name. So should you consider a limited company? This is a fantastic question. We must get asked this at least 10-15 times a day, speaking to people, speaking to clients on the phone. And the answer really is, it depends. What is it you're looking to achieve through business? Where are the funds coming from? Do you have children? Are you looking to do inheritance tax planning? All of these factors go into the equation. If you're looking, as a general guidance, to have £50,000 worth of property income yourself, that's it. That's all you're looking for, essentially. Then maybe you'd be better off in your own name. However, if you're working at the moment, you're a higher rate taxpayer, and you're looking to put that property aside for the future, you don't need the money now, having that limited company set up where the profits are only being taxed at 19% rather than 40% mostly, it's usually a lot better off having a limited company in there, so the profits can accumulate over time, pay 19% corporation tax, so you've got more and more money to snowball, buy deposits, and continue buying houses. These are just some of the factors that you need to take into it when considering, limited company or own name. There's no wrong or right answer. It's just a case of understanding what it is you're looking to achieve, whether you need a limited company with kind of smart shares, fancy share classes to help with inheritance tax planning, profit extraction. And at the end of the day, it's not something that you can really figure out yourself unless you've got a very simple set of circumstances. So the question here is about moving into a limited company. So say for instance you've got 10, 15, 20 properties at least in your own name, you're a higher rate taxpayer, you might already be employed, and basically you want to get them into a limited company because you've done the numbers, you've run through the tax based on a limited company, you don't need the money to live off, and what you're paying currently on self-assessment, and you know that, hang on a minute, I want to be in a limited company because it's going to be saving me tax. So what do you need to consider here? Firstly, is when you're moving property from your own name to a limited company, that's a market value sale, okay? Because your limited company is connected to you, under the tax law, that sale takes place at full market value. So if your property portfolio is worth £5 million, that's the rate it's going to be purchased for, which means you're going to have a capital gain on you personally. So if you're not in a partnership, or if you own your own property portfolio outright, that capital gain will be payable on you, even though you're selling them to your own limited company. There are ways around this. So if you've got a large enough portfolio where you spend at least 20 hours a week per the Ramsey case, working in the business, you self-manage, you check the tenants in, you're very active as a landlord, you might be able to claim on incorporation relief, section 162, and what that does is it defers the gain into the cost of the shares, so there's nothing to pay now, and you'll simply pay when you come to sell the limited company later on down the line. In addition to this, if you've when you're selling these to a limited company, you've also got stamp duty to consider. So for stamp duty as well, there's that market value rule, so you'll pay tax on that £5 million worth of consideration that's going to a limited company. If you've got a partnership, so if it's husband and wife, LLP, partnership, been doing partnership returns, anything along those lines, you might get exemption from stamp duty depending on your circumstances. That's definitely something to check with an advisor about. Otherwise, if you're not in a partnership, you will have to pay stamp duty based on the market value of the properties you're transferring. So that was really it for today's video, just giving you some insight on what you should consider, but making sure that you kind of fully understand that mortgage interest is going to be high, there's accounting fees that come with a limited company that are more than your own name. So really make sure that you understand the numbers and that there are tax differences, and the limited company isn't always going to be the best thing to use. But make sure you do subscribe, plus like this video. If this video's been any good to you at all, you've taken one thing from this, please do hit that subscribe button, hit that like button, so I know to keep doing more of this. Otherwise, my most recent video is just up there, and you can hit there to subscribe. Cheers for watching, guys. Bye for now.